Imagine waking up tomorrow with complete financial freedom. No alarm clock, no fear of bills, no anxiety about the future. Now here's the uncomfortable truth. The difference between those who live that life and those who don't is not intelligence, luck, or talent. It is mindset. According to multiple studies, over 88% of millionaires are self-made, not born into wealth. They didn't win the lottery. They didn't inherit vast fortunes. They built wealth slowly, deliberately, and consistently by thinking differently about money. Today, we are going inside the financial mindset of millionaires and billionaires, not through motivation or hype, but through real data, real behavior, and real decisions that shape extraordinary wealth. This is not about getting rich quick. This is about learning how wealthy people see money, risk, time, and opportunity, and why those perspectives compound into massive financial success over decades. Wealth begins with long-term thinking. One of the most consistent traits among millionaires and billionaires is long-term orientation. A landmark study by Thomas C. Corley, author of Rich Habits, found that 88% of wealthy individuals read at least 30 minutes per day, primarily focusing on self-education and long-term improvement. In contrast, only 2% of people in poverty did the same. Wealthy individuals think in decades, not weeks. They make decisions today based on where they want to be 10 or 20 years from now. This is why they willingly delay gratification. They understand that sacrificing short-term pleasure for long-term gain is not deprivation, it is strategy. Warren Buffett famously said, "Someone's sitting in the shade today because someone planted a tree a long time ago." That statement reflects how the wealthy view money. They see every dollar not as something to spend, but as a seed that can grow over time if placed correctly. Income is important, but control is essential. Many people believe high income automatically leads to wealth. Data proves otherwise. According to a report by Ramsey Solutions analyzing over 10,000 millionaires, the majority did not earn extreme salaries. In fact, the top professions included engineers, accountants, teachers, and managers, not celebrities or athletes. What separated them from others was control over spending. Millionaires consistently live below their means. This behavior is supported by the Millionaire Next Door study, which showed that most wealthy individuals do not drive luxury cars or live in extravagant homes early in their wealth journey. Wealthy people treat lifestyle inflation as a financial threat. Instead of upgrading their lifestyle every time income increases, they redirect excess income toward investments. This discipline allows them to build capital faster and withstand economic downturns. Assets over appearances. One of the clearest mindset differences between the wealthy and the average person is the focus on assets instead of appearances. Assets generate income. Appearances consume it. According to Federal Reserve data, the wealthiest households in the U.S. hold a significant portion of their net worth in business equity, stocks, and real estate, while middle-class households hold most of their wealth in personal residences and depreciating items. Millionaires ask one question before spending money: will this increase or decrease my future income? If the answer is decrease, they pause. They understand that wealth is not what you wear, drive, or post online. Wealth is what you own, control, and compound quietly. Risk is calculated, not avoided. Contrary to popular belief, wealthy individuals are not reckless risk takers. They are educated risk managers. A study published in the Journal of Finance found that successful entrepreneurs and investors are more likely to take calculated risks backed by data, not emotional gambles. They research extensively, diversify investments, and avoid placing all capital into a single opportunity. Billionaires like Ray Dalio emphasize understanding risk so deeply that mistakes become survivable. Dalio's investment philosophy focuses on diversification to reduce downside exposure while allowing upside growth. The wealthy don't fear risk, they fear uninformed risk. Failure is data, not identity. Another defining mindset trait is how wealthy individuals interpret failure. They do not see failure as a reflection of personal worth. Instead, they treat it as feedback. According to research from Harvard Business School, entrepreneurs who failed early and learned from those failures were more likely to succeed in future ventures than those who never failed at all. Elon Musk publicly acknowledged that both SpaceX and Tesla were weeks away from bankruptcy early on. Instead of quitting, he analyzed what went wrong, corrected course, and persisted. Today, both companies are industry leaders. Millionaires understand that setbacks are temporary, but lessons are permanent. Time is more valuable than money. While most people trade time for money, wealthy individuals aim to decouple income from time. This mindset shift is crucial. A report by the U.S. Bureau of Labor Statistics shows that wage growth has remained relatively stagnant over decades when adjusted for inflation. Wealthy individuals recognize that relying solely on hourly wages limits financial growth. Instead, they pursue scalable income sources, business ownership, investments, intellectual property, and equity. They aim to earn while they sleep, not because it's a slogan, but because time is finite. This is why the wealthy invest heavily in systems, automation, and delegation. Education never stops. Formal education may end, but financial education never does. According to the National Endowment for Financial Education, individuals with higher financial literacy are significantly more likely to accumulate wealth and avoid high-interest debt. Millionaires read financial statements, understand taxes, and stay informed about economic trends. They don't rely blindly on advisors, they seek understanding. Billionaires like Bill Gates and Charlie Munger are known for spending hours each day reading. Knowledge compounds just like money. Taxes are strategically managed. Another critical difference is how the wealthy view taxes. Instead of seeing taxes as unavoidable losses, they see them as a planning variable. According to IRS data, high net worth individuals legally reduce tax liability through retirement accounts, business deductions, depreciation, and long-term capital gains strategies. This is not evasion. It is optimization within the law. Wealthy individuals build teams, accountants, tax strategists, and legal advisors to protect and grow capital efficiently. Multiple streams of income. Our standard research from the IRS shows that the average millionaire has at least 3 income streams, while many have 5 or more. These include earned income, investment income, rental income, business income, and royalties. Relying on a single income source is considered risky in the wealthy mindset. Diversification applies not only to investments, but also to income. This approach increases resilience during economic downturns and accelerates wealth accumulation. Emotional control. Around money, money decisions are emotional for most people. Fear, greed, comparison, and impatience drive poor choices. Wealthy individuals train themselves to remain emotionally neutral with money. Behavioral finance research shows that emotional investors underperform the market by significant margins due to panic selling and impulsive buying. Millionaires follow rules, systems, and principles rather than reacting to headlines or social pressure. Wealth is built quietly. One of the most surprising truths about millionaires is how ordinary they appear. Real wealth is often invisible. According to the Millionaire Next Door, many millionaires live in modest neighborhoods, drive reliable vehicles, and avoid unnecessary attention. They prioritize freedom over status. They understand that flashy spending delays financial independence. Giving is part of the mindset. Philanthropy is not an afterthought. It is a core value. Studies from Indiana University's Lilly Family School of Philanthropy show that wealthy individuals give a higher percentage of their income to charity than lower income groups. Giving reinforces abundance thinking and builds social capital, trust, and legacy. The mindset is the real asset. Ultimately, money is a result, not the cause. The financial mindset of millionaires and billionaires is built on discipline, patience, education, and intentional decision-making. They don't chase money. They build systems that attract it. They don't blame circumstances. They adapt. They don't wait for opportunity. They prepare for it. If this video helped shift how you think about money, even slightly, imagine what consistent learning could do for your future. Financial freedom starts with awareness, grows with discipline, and compounds with time. If you want more content that breaks down real wealth principles using real data, not hype, subscribe to this channel right now. Turn on notifications so you don't miss the next video, because every lesson you apply today brings you one step closer to financial independence tomorrow. Your mindset determines your money, and your money determines your freedom.